with the deeply tragic crisis currently taking place, the importance of corporate decision makers, leaders, and investors and the roles they play in our global societal well-being has been brought to the forefront. And a key aspect of that is investment stewardship. And with that, I'd like to open our panel on actioning stewardship and start by introducing our tremendous panel of experts. Tilly Franklin is the CEO and Chief Investment Officer of the Cambridge University Endowment Fund. Prior to joining Cambridge University, Tilly has held a number of roles within investing and consulting, and was most recently head of private equity at Alta Advisors. She is a graduate of Cambridge University and the London Business School, and also recently received the 100 Women in Finance's 2021 EMEA Industry Leadership Award. Tilly is also a co-founder of Girls Are Investors, or GAIN, whose mandate is to inspire girls to enter the financial services industry. Welcome, Tilly. Deborah Gilshan is an expert advisor on investment stewardship and ESG, and the founder of the 100% Club, a multi-sector alliance dedicated to gender diversity. She serves on the advisory panel of the UK's Financial Reporting Council, FRC, is also a fellow of the Governance Institute. Deborah was previously an ESG investment director at Aberdeen Standard Investments and the head of sustainable ownership at Railpen, one of the UK's largest pension funds. She is a graduate of Manchester University and has been recognised for her work on empowering the female talent pipeline and promoting gender diversity. Anubhuti Gupta, Anu Gupta, is the head of investment for APAC for Rosenberg Equities and is a Singapore CEO for AXA Investment Managers, with whom she's had a number of leading investment roles, including head of portfolio management, and where she's currently responsible for Asian investment strategies. Anu is a member of the Global Rosenberg Management Committee and the Investment Committee, and holds, educationally, she's studied at NTU, Nanyang Technology University, Singapore, and holds an MSc in Financial Engineering. She also has a certificate in Computational Finance from Carnegie Mellon. Anu is a CFA chartered holder and also a KAIA analyst, a KAIA chart holder as well, and is a member of the CFA Institute's Education Advisory Committee and the Nominating Committee for its Board of Governors. Uche Orji is a Managing Director and the Chief Executive Officer of the Nigeria Sovereign Investment Authority. Uche joined the Sovereign Wealth Fund as its pioneer CEO in October 2012 from UBS Securities in New York, where he's a Managing Director and a top-ranked equities sell-side analyst. Prior to his sell-side experience, Uche has worked on the buy side with Goldman Sachs Asset Management as an analyst portfolio manager. Uche holds a bachelor's in engineering from the University of Port Harcourt in Nigeria, and also an MBA from Harvard Business School. He's the chairperson of the board of Impra Credit and holds a number of high-profile board roles, including at the Board of Development and at the Bank of Nigeria. Uche is also a member of the G7 Task Force on Impact Investing. So with that, I'd like to welcome everybody to this panel and this conversation with respect to actioning stewardship. I'd like to start by asking the participants joining this session to respond to a poll question. And one of the key conversations within stewardship is obviously divestment versus engagement. And should companies that are not implementing responsible strategies the way that investors would like them to, should those investors then think of divesting? And with that, I'd like to open with a poll question, and we probably have to wait a few seconds for the poll question to come up. And the poll question is, do you think that institutional investors should divest from companies if they feel that company engagement isn't delivering intended outcomes within defined time periods? And a simple yes or no. So I'll just repeat the poll question again. Do you think that institutional investors should divest from companies if they feel that company engagement isn't delivering intended outcomes within defined time periods? Yes or no? So we'll just give it a few seconds for people to share their responses. And if we could see the results of the poll. So we basically have 83% saying that institutional investors should divest from companies if companies aren't delivering meaningful results within a reasonable period of time, and around 17% saying no. So that's an interesting statistic to start with. And Christine, if I may start with you, you're currently a board member and have a very long involvement with ICGN, International Corporate Governance Network, which was set up in 1995, which currently has the support of investors responsible for approximately, close to 60 trillion of assets under management. Christine, what do you think are the key priorities for asset owners and asset managers as they look towards actioning stewardship? And it may be the case that Christine is having some technical difficulties at the moment, just joining the call. But what I'd do is I'd like to ask the question and put it out in front of our panel. I mean, what do you think are the key priorities for asset owners and asset managers today as they look towards actioning stewardship? Perhaps, Deborah, you'd like to share your thoughts?
Yes, I mean, I think the role of investment stewardship is so fundamental to the role that asset managers and asset owners and other types of investors have. I think it's quite distinct from portfolio management and from even ESG integration. It's a pretty fundamental role of finance and how investors as owners and on behalf of their clients hold companies to account. I think it's quite a unique skill set and it's really evolving. Obviously, the stewardship code, the first iteration in the UK, came out of the Walker Review post the financial crisis around the idea of where we are the shareholders. And I think we still are evolving as to what impactful, forceful stewardship looks like to get the best long-term outcomes for end beneficiaries. I believe it's how we demonstrate the social utility of finance and also how we net back to end savers and investors and rebuild trust. So I couldn't, I guess, put it more importantly in terms of how important I think this function is for finance and for investment.
Yeah, thank you for sharing that. And obviously, this idea of social utility of finance and rebuilding trust is, especially following the global financial crisis, is really an imperative. Would others like to share their thoughts just with respect to, some of the sort of some of the sort of major priorities for asset owners and asset managers as we look towards the stewardship agenda?
I'm happy to jump in.
Please.
See if Cambridge is a relatively small asset owner in the global scheme of things in terms of priority. Just targeted. So we're really focusing very specifically on greenhouse gas emissions reduction in our underlying portfolio companies, and then also on diversity and inclusion within our fund managers and teams, because we think actually having more diversity within fund managers is creates a sort of virtuous effect of bringing in perspective and actually highlighting the other issues that we care about. So we also face a slightly more complex picture when we think about stewardship, because we only use through third-party fund managers. So we're at one remove from the actual companies and securities in question. So we're having to exercise our influence through those fund managers, which can be related to
Tilly, thanks very much for sharing that. And perhaps we can just sort of continue on that theme. I mean, obviously, it was a big decision that the Cambridge University Endowment took. I mean, Cambridge University Endowment Fund is a globally recognised endowment, and the decision was taken. Historic decision was taken in 2019. So probably one of the early adopters to sort of to follow the divestment investment direction, and other institutions have followed suit, and we've had ABP. One of Europe's largest pension funds, make a similar sort of decision more recently and over the course of the last few months. What are some of the challenges that you faced trying to continue or persist with this policy? What's the kind of what have the challenges been, and what's the I guess what have been potentially the criticisms that people have shared about going down this taking this direction with respect to the overall fiduciary responsibility of managing the fund's assets?
Sure, that's really not but I think it's interesting because divestment always kind of captures the headlines because it's something that's very concrete and people get their sort of arms around it. But actually, the announcement that we made in October 2020 that we were going to phase out fossil fuels from the portfolio was actually part of a broader announcement that we made about our overarching goal, which is to achieve net zero emissions from the underlying portfolio by 2038. And when we talk about achieving net zero, we're not talking about doing that primarily through an exclusionary approach. It's actually about trying to use our influence and work with managers to actually reduce the emissions that are being generated by the portfolio companies that we own. So that, the idea is that the same unit of economic activity will have to be generated with fewer and eventually zero emissions in the future across the board. Otherwise, clearly we'll have larger problems, but we're just trying to be at the forefront of that transition. In terms of divestment itself, obviously that was an important part of the strategy, and that made a lot of the headlines. I think it's a really important tool in the toolkit because I think there are two potential benefits that can ensue. One is that if you are a brand like Cambridge University, which is a leading scientific educational institution, I think saying that you're not going to invest in a certain sector can have a delegitimizing kind of effect within that sector. And of course, we're seeing that play out now in real time with regards to ownership of securities in Russia in a very different context, but with a similar objective. And I think also, frankly, many of our stakeholders just didn't want to own these securities. So that was clearly another important consideration. But at the same time, I also believe that divestment is one tool in the toolkit. Clearly, if you divest from a security, likely enough, someone else has to own it. So the securities are still out there in the market. And so that's why, for me, our engagement with fund managers is really the kind of most impactful element of our approach. In terms of the criticism I've received, I mean, there has been years debate about, people either care about fiduciary responsibility or environmental responsibility. I think that debate is really collapsing as we accelerate towards the need for the energy transition. So I no longer feel that we necessarily have to sacrifice financial returns to achieve these goals, particularly not if you take a long perspective. I mean, clearly in the short term, there can be issues, as we see now, with energy prices being one of the few sort of bright spots, as it were. But I'm not a commodity trader, so my ability to benefit from that volatility would be very marginal in any case. So we're content to take a confident approach in this area.
Thanks for sharing some worthwhile insights. And I'll just quickly check, because I think obviously there's a lot going on at the moment. So I know some people have had to potentially join the call, but also having some connection issues as well. So quickly check if Uche, are you on the call at the moment? Okay. So I can't hear Uche on the call at the moment. So, but what I'd like to do is I'd like to pick up on your point, Tilly, talking about asset managers, and you can probably, guess I'm going to move to Anu, who, in her role at AXA Investment Managers in Asia. And I'd just like to ask you the following question. IAS talk about the fact that accelerated industrialization of Asia Pacific as a region has come with a lot of negative consequences, especially in terms of sustainability. Social protection, and sort of cite other industries as materials, industrials, and consumer staples industries as high on their controversies list. So we know that those three industry groups, those sectors are sort of very high on the controversies list, especially in Asia. They also talk about the fact that APAC currently, as a region, has 9 active stewardship codes, which perhaps people may not be aware. And that's from over the fact that we've got about 20 stewardship codes globally. So just given your role as head of APAC Equities, can you share your thoughts on where the region is with respect to its stewardship practices and what needs to happen to accelerate change, especially in APAC?
Sure. Thanks, Surya. And I just wanted to, tell everyone that it's a real pleasure to be here on this esteemed panel. Really, it's a very important discussion that we are having. So talking about Asia Pacific as a region, I think we have seen good progress. And like Europe, like the rest of the world, the direction of travel is firmly in the forward direction, which is very heartening to see. And you mentioned the various active stewardship codes that we have here. So that's really a function of two things. Firstly, the region is very diverse. And secondly, the regulators and industry bodies, they have been really proactive in the adoption and development of such codes. So we have the codes, but one thing that remains debatable is the effectiveness of these codes. And before I talk about it is worthwhile noting some of the unique aspects of the Asian context to appreciate why we are where we are and how we can potentially speed up the progress. So the first point that comes to mind is the ownership structures. And there are two key aspects to that. One is the ownership concentration is very high in Asia Pacific when you compare it with, say, US or UK. Be it the chaebols in Korea, cross-shareholdings in Japan, or the state ownership in Singapore and Hong Kong. The other key difference is the low levels of institutional ownership. So in APAC, Japan and Australia, they have the highest levels of institutional ownership, but even for them, it is less than half of what you see in US and UK. And if you look at markets like Singapore, it's even more stark, where the institutional investors, they own only 6% of the local equity market. So what it does is it makes it that much harder for institutional investors to be motivated, first of all, and effective in their role as stewards. The second thing that I would like to bring to the floor is the complexity that is involved in navigating multiple codes and local country contexts for managers like ourselves who are running global and regional portfolios. I mean, the local context is important, and each market, it has its own motivations. So it's important to factor this in, but it does add to the complexity. I mean, an example, if you look at the motivation of stewardship codes, the original UK code, it was designed to discourage excessive risk-taking. But on the other hand, for companies in Japan, for instance, one of the key motivation for the code is to encourage more risk-taking. Also, I'm based in Singapore, so I'm going to talk a little bit about that. Here, the story is yet again different. Companies which are listed in Singapore, they tend to be dominated by the government and families as controlling shareholders. And Singapore actually already has a very robust corporate governance system. So the main purpose that the stewardship code is serving here is really for halo signaling purposes. So given all this, there is a good awareness of the concepts of stewardship in general, but not so much of the specifics of local codes. And I see this reflected in the investor behavior generally in the markets. So the APAC investors, they tend to consider the stewardship principles generally to some extent when they make investment decisions. But talking about engagement is a different story. It's mixed. And some of the barriers I think these are the barriers that we face all over the world: high costs of engagement and the lack of a clear link between value creation and engagement in the short to medium term. So this is one of the challenges. And the other thing that I don't see happening enough of here is collective engagement, which I personally and my firm believes that it can be a really powerful tool. There are challenges to it, and I think we can definitely do more on that front in Asia. So there are also mixed views around enforcement. So majority in this region, we favor the comply or explain approach, but there is a significant population that is not convinced by this method. And personally, I think it's going to be a fine balancing act, not just here, but globally. I think codes should remain a comply or explain standard. Otherwise, it becomes a box-ticking exercise. But then it should also be sufficiently monitored to ensure that the signatories, they are following through on their stated policies and living up to the professional standard that they are being held to. So with this scene setting, I think the key to accelerating the stewardship ideas in the region is that the key to that is increasing awareness. So the local regulators and industry bodies, they should ensure that firstly, the institutional investors, they have ample opportunities to learn in detail how to practice responsible share ownership. And if you see, like, there's a tangible example of that. In Asia Pacific, for instance, the awareness is definitely a lot higher in Japan, where the top-down push is stronger. And this awareness, on the other hand, remains relatively low in other markets. The other thing that basically drives everything is the correct incentivization. So having asset owners push more strongly for stewardship can increase adoption and awareness, given the level of direct influence they have on asset managers. So, for example, again, talking about Japan, the Government Pension Investment Fund, they have been very vocal in pushing for more stewardship. And in fact, we have so many large asset owners here in APAC who can really help to drive change. So I think they need to play a bigger and more key role in moving this forward. And finally, we need simplification of codes. We have 9 stewardship codes and it's growing. So there, I think adopting global practices and common core principles will definitely help in streamlining matters, while we tackle the local nuances through supplemental principles. So what this would do is it will cut down on the complexity. It will allow investors to follow a core stewardship code and then provide supplemental documentation for each market to fulfill the local needs.
So, Anu, thank you very much for sharing some great insights, and there's really a lot there to start unpacking. And I guess maybe just touching on some of the highlights of your analysis. I mean, the ownership structures are very key in Asia. The fact that obviously family ownership and sort of family entrepreneurship in a lot of ways has a very different ownership structure. And you sort of made mention of statistics that were different to institutional investors or the institutional ownership of companies in the region. You know, potentially half of that, half of what they are in developed markets, the US and UK, as an example. You talked about 6% institutional investors actually holding Singaporean assets that are listed in Singapore. And also just the idea that the code potentially had a very different actioning point. So in Japan, maybe the idea was to try and increase risk-taking vis-a-vis in developed markets, where it's obviously to try and curtail or more prudent management of a company's practices. And also, sort of talking about other things, the idea of sort of collective engagement as well, and how that could be probably better actioned in Asia, potentially. I think that was a good point to share. You also very kindly talked about the GPIF, the Japanese government pension fund. And I remember Hiro Mizuno in 2018 when he came on board and was making the case, sort of, I think internationally, to try and talk about universal ownership and the idea that it was actually in the best interest of all to try and move to an investing culture of basically investing for the benefit of all, for a societal benefit, as opposed to just strictly speaking stakeholders, for the simple reason that stakeholders themselves would benefit in the mid to long term from the accruing benefits of moving towards universal ownership. So I do remember that also being a key point. I also recall that one of the key concerns and criticisms was how active managers would continue to manage, would survive, I guess, efficiently deliver their best services given his very aggressive pricing structure. That was something that was also very much on the forefront. And just this idea of ETFs and how that could potentially be managed. And I guess with that, it's nice to sort of become a little bit more granular. Deborah, I'd like to ask you, I mean, you've had a valuable career, fantastic career experience with actually multiple aspects of the stewardship value chain. Could you please share your thoughts on the spectrum of opportunities available to investors and lenders as they look towards actioning stewardship, and how would they use these, as a standalone basis or a combination of strategies, and also ultimately trying to achieve their intended outcomes? It'd be great to hear your thoughts and more color on that, both I guess for investors as well as for lenders, people
Sure.
on the debt side.
Yeah, I mean, I started my comments by saying I think, stewardship is still evolving, and so much of what Anu said in particular really resonated, and I'll reflect back on some of that through my comments. But as well, we started with a poll engagement or divestment, but actually that's not the only options. Those are options available to you in your toolbox, but actually what I really like to see is much more use of all of the shareholder rights available to providers of capital, including equity holders as well as bond holders. So certainly if I talk about the UK context, in the UK as an equity shareholder, you have a number of rights, including voting on key issues of governance and oversight of a company that you own on behalf of your clients. You also have the right to call a general meeting. You have the right to propose a shareholder resolution. You have the right to attend the annual general meeting and ask any question that you want as a member of the organisation and of the company. And you also have, the ability to collaborate with others and to kind of, again, escalate engagement if you feel that that's what you need to do. And obviously the ultimate sanction, if you're an active manager, is divestment. And I guess I've done all of those things, both working for two asset owners as well as an asset manager. And I'd really be keen to see investment stewardship move outside of these kind of engagement or divestment, but actually use the full spectrum of rights that are available to equity holders and bond holders. One of the most powerful meetings that I've ever had was with a US company where we had proposed a shareholder resolution as an asset owner when I worked at RealPen, and we proposed a resolution on independent chairperson, and there was lots of issues in the company that came to the fore, and the first thing they did was appoint an independent board chair. And we went to engage with them, and we said we don't only own equity, we also have fixed income exposure. And so the economic exposure that we had was a lot higher than just our equity holding. And I could tell the chair was quite, taken with this idea that actually it wasn't just public equities that we held, that our overall economic exposure was bigger. And I think you're beginning to see much more working together of fixed income teams with equity teams within fund management houses and asset owners as they begin to leverage that I guess, advantage to some extent. Going back to what Anu said about the force and the power of asset owners on stewardship codes, I was reflecting again when I was at RealPen. RealPen led an initiative when the first stewardship code came out in 2010 to say this really matters for asset owners. The role of asset owners in the investment stewardship code is so fundamental. And actually now the more updated version has a whole set of principles for asset owners and asset managers. So I think we have to recognise the distinction of the different roles in the stewardship ecosystem. And I also was glad to hear Anu's points about AXA being really interested in collaboration, because I think that's so important and it's so efficient, and it's such a way to give a collective voice to an issue that you may be raising in private dialogue, but actually you can enforce that, or I guess raise your voice even louder through collective, action and collective voice. And, John Kay's report into, I guess, what talked about putting stewardship at the heart of investment was really about voice over exit. And I do believe exit has a role to play. But I think we have to ensure that we use all of the voice as available to us. And we talked about the GPIF. Actually, one of the initiatives that GPIF got involved with the 30% Club Investor Group here in the UK, which I think is a really good example. I'm slightly biased because I was part of it for quite a while, but the trajectory of the growth of the investor group here in the UK, engaging with companies on all types of diversity. It's gone, I think we started with something like 7 members, 1.6 trillion in assets under management. It's now something like over 40 members, 11 trillion pounds in assets. We just put out a statement recently on engagement on race and ethnicity in FTSE 350 companies. And I think those types of collaborative initiatives, I think, are so important, especially as we try to address systemic issues around climate change, around inequalities. So I think, investment stewardship is just going through so much evolution. And I think we have to realise as well that really, regardless of the type of capitalism you ascribe to, whether it's shareholder capitalism, stakeholder capitalism, or my view is it's something in between, that actually working as a shareholder, it has wider societal benefits for other stakeholders. Actually, the role of investment stewardship is fundamental to both, if we think there are two types of capitalism. So for all of those reasons, I think it's really important that we recognise the skill set that is needed to really demonstrate the role of investment stewardship as well.
Thank you, Deborah. Some great thoughts being shared there. I mean, especially with respect to the spectrum of opportunities and strategies that are available to to investors, and it's not just black or white divestment versus engagement. Thank you very much for sharing the great examples. I mean, Railpen and obviously the 30% Club, and I know that you've played a huge part in obviously driving that initiative. Over the years, it's grown to be extremely successful. And just obviously some of we talked about collaboration being key, and just the rights that you have as a debt holder, and more so as an equity holder. But the idea that those rights are can be actioned effectively with respect to company management. I think that's been a very key message, and just this evolution of shareholders and basically coalitions, and how actioning some of this is also continuing to give to strategies. I think that's been helpful to hear as well. And obviously just kicking off with obviously Railpen's involvement with the 2010 Stewardship Code. I guess sort of moving forward from there, and I'll just ask everyone in the audience, please do share questions. We've had some questions come in, so we're going to move to those shortly. But if you have questions, then we've got a fantastic expert panel, so do bring your questions through. And I'd just like to ask the panel their thoughts on the following. So Share Action published a very well-read report called Voting 2021. So it's basically an annual voting report. And I just want to cite from this report. And basically, they stated that the very largest asset managers' voting records provide particular concern. Share Action state that many asset managers are not exercising their voting rights, citing 7 managers, 5 of whom are actually members of Climate Action 100+, which is one of the largest initiatives of asset managers and asset owners with respect to actioning a climate responsible agenda for companies. And they talk about the fact that basically 5 of those 7 managers who aren't actioning their votes are members of Climate Action 100+. And they're voting on fewer than 60% of resolutions. They also make mention of when talking about social issues, the report states that the asset management sector is failing to support the vast majority of resolutions focused on social issues, with considerably lower levels of support compared to environmental resolutions. Just given their findings, the growing imperative behind ESG and responsible investing, why do you think that asset managers and potentially asset owners are slow to board the train on voting, and especially with regards to social issues? I'll just open that up to the panel to share their thoughts. Deborah, you're on mute.
Yeah, we're able to get through without doing that. It demonstrates how much focus importance was given to voting. It's such a fundamental right that you have, as I said. And I think voting analysis of the great work that the likes of Share Action does, it tells you one story, but it is a bit more nuanced than that. But I think it's more and more a way in which asset owners and other stakeholders assess what's being done on their behalf. Obviously, there's a lot of engagement that goes on between asset owners and asset managers when it comes to voting and engagement and everything else that we talked about. I would also say that there is only often 2 votes for or against. I often hear fund managers say, "Oh well, it was a really kind of voted for, but we really it was like, well, you still contentious for voting for." So I think it just does demonstrate the importance of voting, but also that asset managers and asset owners tell their story around how their voting reflects what they're doing on behalf of the client, what engagement, in addition to voting, because voting is obviously engagement, and I guess that wider narrative, which I believe that the updated Stewardship Code in the UK really gives the opportunity that it's putting the voting statistics into context, but it does straight voting is often views whether we say, well, we'll vote against directors. We don't want to file shareholder proposals. We don't want to make a statement at an annual general meeting, but, we will vote against directors. And then you look at voting records and there's not much votes against directors. So I think it's trying to understand the nuances around what voting tells us. But I do think analysis is extremely important. And we didn't have this for many years. I mean, I started my career at the Corporate Insurance Society in Manchester, whose assets are now owned by Royal London Asset Management, and we were the first UK institutional investor to disclose our full voting records in 2002, I think it was. And we were criticised for that level of transparency, but actually it's really necessary now. We knew what other people's beliefs, other people's goals. And so I do believe voting transparency and voting analysis is a really important accountability as well.
Yeah, I agree with Deborah. I think what is happening with voting is a lot of it is outsourced. And people think that ISS is doing it for you, then it's not your problem. I do see the value in doing this outsourcing and pooling resources, but I think it's important, as Deborah mentioned, to first of all have some well-defined policies a priori as to why we are voting the way we are voting, and providing transparency around the votes, especially the ones where we are voting against the resolution. And I think the other thing is also the way the whole proxy season and voting works. A lot of it tends to be very concentrated. And in fact, I would say I read about this in the CFA ESG certificate program, which I just did in December. They make a good point. Actually, if you attend the meetings, there is a lot of information that you can glean from those meetings. There was good access to the entire board, the management. But unfortunately, because everything gets back through days, that doesn't really happen. So there's not a lot of people are not able to see how their voting is actually influencing the outcome. And if we can start creating that link in a bigger way, I believe people will start taking the voting business more seriously. Is there some echo? Can you hear? I'm hearing some strange echoes.
Yeah, there is some. I think there are some sound quality issues at the moment. So I'm hoping that it doesn't take away from all of the great insights that we're hearing at the moment. And I think you mentioned some great points there, Anu, with respect to the proxy advisors and the kind of guidance that institutional investors take away from them. And I sort of takes me back to the example of BHP Billiton last year, when you had two proxy advisors. You had ISS, you had Glass Lewis. ISS, and the resolution was to approve their sustainability report, if I remember correctly. And ISS was on board with that. And Glass Lewis actually recommended to vote against that, because they felt that BHP wasn't meeting certain criterion with respect to their Climate Action 100 objectives, and also their Transition Pathway initiative as well. So, if you're an institutional investor, you're hearing one proxy advisor suggest one thing, another one suggests another thing. Then again, it does definitely lead to more more conscientious decision making with respect to how you're going to action that respective stewardship vote. So I think some great insights are coming there, especially with respect to the proxy advisors. Just keeping track of time, I'd like to also ask the questions that are coming in. So I'd like to just ask the panel a question that's coming from Stella. How do you envisage corrective incentivization at a company level through remuneration linked to ESG, advancements in training? What are your thoughts? And I think that brings out many things with respect to, obviously, ESG performance, sustainability metrics tied to remuneration, as an example, to executive pay. Potentially training is also another avenue or opportunity. So I'd just like to sort of open that question up to the panel. Thanks.
Well, we have actually seen this, but so far it's been more in our private equity portfolio. So I know we're talking a lot about public listed companies here, but as a diversified asset owner, we own, we work with fund managers in all different asset classes. And one of our private equity funds recently announced science-based emissions reductions targets for the entire portfolio. And then they have also sort of fed that all through into the executive compensation scheme, which I think is really, really fascinating development. So I think we're going to see a lot more of this. And I mean, I think in a way it's almost coming to the point where now, if the goals are not reflected in executive compensation in some way, then it almost calls into question, how serious the company is about achieving those goals. So, and I think it's definitely an area to watch very closely.
Thank you, Tilly. And you made some great points about obviously that linkage. And I guess almost going back to Asia-Pac and the family ownership structure. So when you've got a large family business that's grown, obviously with, a founder and then obviously his heirs following that and obviously taking on board the business, having those, having that kind of decision or transparency with respect to a lot of board decisions becomes far more challenging as such. Anu, would you like to share some thoughts with respect to family ownership and obviously challenges at the board level with respect to family ownership?
Sure. Yeah, I think the way we need to look at it is somewhat different, Arun. And again, the key there is increasing awareness and educating them. So in fact, what I'm seeing in Singapore, like in the family office space, they are increasingly becoming aware of the importance of incorporating ESG concepts into their investments, because they're looking to build a legacy. So they tend to be more long-term focused. And the ESG concepts align very nicely with this long-term view that family offices take. So in fact, in Singapore, there's a code specifically for family offices to help them understand the importance of these concepts. So I think there, the key thing really will be education and awareness. And in fact, somehow getting it ingrained into their systems that it's important. And it is actually for the benefit of their portfolios long term. Because once you create that link and once they're convinced, then it is something that they will automatically start doing. And talking about education for AXA-IM, we again believe that in order to bring everybody on board, our portfolio managers, analysts, researchers, and anybody in the company, they need to understand why it is important. So we have been actively running a lot of programs in-house, and we are also encouraging them to take up certifications like the CFA ESG certificate to improve their knowledge. And once people understand and are convinced of the importance of these concepts, then the work is done. They will automatically start incorporating this into their day-to-day lives, the way they manage their assets and the way they actually run the company.
I think as well, Aaron, we're talking about kind of incentivizing, what gets measured gets managed, what you get paid for, you do. But actually it's about, behaviours and outcomes. And if we think about the board, because, shareholders have voting rights to vote against or vote for director elections, there's quite a lot of outcomes. And we talk about stewardship, investment stewardship, by investors, but actually stewardship is shared with the board of directors, right? You can engage and you can vote, but if a board is intransigent to change or doesn't listen, then what happens then? There's numerous examples on the advisory votes on remuneration here in the UK where shareholders actually vote it down. They in a majority vote against the resolution. So they're signalling to the company, we in a majority clearly disagree with the outcomes and decisions that you've made. And nothing happens. The only outcome I've ever seen is more engagement. Why would I want to engage more with a resolution and structures that I fully understood and did not think it was in my client's best interest to support? So I think we need to think about the futility of engagement as well, because that to me is escalation, where you take it to the board to say, you're not listening to the strong signal that shareholders are sending you through the vote. And we've just talked about where, shareholders don't vote against. There's instances where they do vote against and there's, huge signals, and boards tend to think it's just about more conversations. I think that's where we need to kind of focus and perhaps think how we encourage, and I hate to use the word incentivize, but incentivize boards to respond. I just wanted to also say that, you mentioned the Share Action Report. There was some good news from the Share Action Report, because on diversity, and we're talking about ESG and inclusion, diversity and inclusion at the heart of ESG, their report from November 2021 found that of the 89 social resolutions that they looked at of the voting of 65 of the world's largest asset managers, 13 resolutions, so 15%, received majority support from asset managers. Again, it's very unusual for asset managers to vote investors to vote, in a majority support of shareholder resolutions. And all of these resolutions were about disclosure of diversity data, and disclosure-related resolutions received significantly more support than other social resolutions. And data from the Sustainable Investment Institute in the US tells us there's been a year-on-year increase in shareholder proposals on diversity. And this proxy season alone, you're looking at 151 shareholder resolutions across board diversity, data, fair pay, racial justice. A civil rights audit that was proposed at Apple last week received 54% majority support. So I think I'm encouraged by some of these data points in terms of the use of all of the rights that are available to us. But equally, we don't tend to see fund managers, asset managers filing shareholder proposal. It tends to be the remit of share action or asset owners. So I think there's real kind of anomalies about the stewardship landscape that I think we really need to unpick and understand.
Thanks, Deborah. And that's, those are, valuable statistics to sort of share how we are, as an investment body, asset owners, asset managers, moving, meaningfully down that agenda. And I think even on the company side, following the European Green Deal, we've got the EU social taxonomy. So the social taxonomy is following the green taxonomy, and so that's being proposed as of the moment. And then I think we're also seeing on in terms of a number of asset owners sort of talking about the fact that maybe revisiting divestment, but the idea that frequent violators of the United Nations Global Compact, so UNGC, do suddenly become divestment candidates if they don't remedy their actions over a period of time. So, and these are some of the most widely held companies globally. So, core portfolios, and some of those usual suspects we know only too well. So we're coming towards the end of our session now. So I'd like to take this opportunity to thank our panel for taking the time both to prepare and also to join us today during this time. And so thank you very much, Anu. Thank you very much, Tilly. Thank you very much, Deborah. And thanks again to Uche and Christine, who unfortunately have had some challenges joining us in the final session, but were involved obviously in the build-up to this session. So my thanks to all of the panelists. And then finally, I'd like to thank you for taking the time, for everyone who's listening to this session. These are really, really important, critical discussion topics, especially for our industry. And I'd like to think you've taken some valuable takeaways from this session. So thanks very much, everyone, for joining, and I wish you a good afternoon and enjoy the rest of the sessions.
Thanks. It's been a pleasure.
Thank you. It's been a pleasure.